Are you looking for some really wonderful long-term capital gains, the opportunity to partake in a very powerful upward move? Want to collect some dividends along the way? Are you looking for a strong and stable company that's going to be a really good fit in your portfolio? Let me take you through one of the investments, one of the holdings in my family's portfolio today, Comcast, and I'll let you know what I'm looking at, and we'll look at some of those key fundamental details as well as some really important key performance indicators for the various parts of their business. So let's get into it. Okay, so here we are back in FastGraphs. As I've said, this is a very fantastic and visual platform. It's one that I absolutely love. It fits my way of thinking, my way of visualizing, and it also fits my basic core philosophy and belief in value investing and buying at a good price below the intrinsic value of stocks, which will be an attempt to reduce my downside risk as well as locking in larger dividend yields. So when we're beginning to think about this, what I've done is I've used FastGraphs here to use a commonly used adjusted operating earnings, and I've got this shown on the chart. Now when we think about it, this orange line here, and what I'm going to do is I'm going to take off the prices. The orange line here is the 15 times price to earnings line. The blue line is 25 times, so price to earnings almost. The blue line there is the 21 times. Now essentially what it's normally grown at has been about 21 times. It's been trading at about 21 times earnings over the years. Since 2008 paying a dividend, and we can see that the dividend payout ratio is fairly safe at about 30%. There's been times when it's been higher, but they've tried to, I think, keep it reasonably stable at this level over the longer period of time. Now, importantly, as well, as we come down here, we can also look at the analyst scorecard, and we can see the analyst expectations and forecasts of adjusted operating earnings. They've tend to be hit 2 years out most of the time, and then occasionally beating 2 years out. So a company here which is reasonably stable, which is operating well, where the management team is providing good guidance, and so the analysts can do a good job in terms of those expectations. Now when we put the prices on the chart, we can see before the global financial crisis here in 2008 that the stock was trading at very high multiples, and then in 2008 dropping down to about 12 times, and then following this blue line for a while. This is why I wouldn't even bother with the blue line so much, and I'll show you how dynamic FastGraphs is in a few minutes. But we can see here that it followed the earnings up, became a bit disconnected here in 2018, followed earnings up again here into 2021, and then I've started accumulating down here in 2022, 2023, and holding now into 2024. Now at the lowest point here, it was trading at 8.4 times on a price to earnings basis, trading currently at about 10.7 times on a price to earnings basis. It has a 2.86% dividend yield. Where do we go from here? Is it just operating earnings? Now, FastGraphs gives us a number of different metrics and measures. I can look at the operating cash flow. We can see that in general that's also been increasing, and prices have generally been following that. And again, we can see that the analysts have fairly good estimates and a fairly good track record for estimating operating cash flows. And also, if I scroll down, I think another good one here is sales. We can see that sales have been increasing, and by and large, the prices have been following that upwards trend, with again that disconnect here in the last year, which doesn't really reflect the constant increase in sales here. And again, we can see an admirable track record for 2 years out for these analyst forecasts. Now, this is a company that's got a reasonable amount of debt here at 54% in terms of debt to capital, S&P credit rating of A- and $172 billion market cap. So, what could go wrong? What can go right? Now, if we look at the overall performance here over time, and we scroll down, we can see that the dividend growth rate has been double digits for a while, then dropping down into the mid single digits here. So it certainly isn't as strong as it has been in the past, but over this period of time the compounding growth rate has been just under 9% compared to the S&P 500, about just under 10%. So a reasonably strong performer. And of course it varies more than the S&P 500 as well. So when we buy at the right time, when it's at good value, then we can do very well. Now you've got to remember also At this 2004, it was horribly overpriced. As I said before, the price to earnings ratio was very high, and so that's skewing things a little bit. Now, if we take that off, what we can do, is we can shift it here to a more reasonable level. And what I'm going to do is I'm going to bring this back to the adjusted or operating earnings, and we can see here that the orange now reverts to a 15 times price to earnings, and the blue line here representing 16 2/3 for a price to earnings multiple. And we can see here that the black line prices are now trading under, and usually when that's happened in the past, say 2017 through to 2020, prices have reverted at some point to peaking up and over that point. The most recent highs above it being about 20 times PE, and also back here 20 times PE. If you were looking to buy now and hold it to 20 times PE, that could be quite a large price gain. One of the beautiful things about FastGraphs is it has the forecasting calculator in as well. Now, we know in recent years we can see here that it's been trading at about 14 times price to earnings. So I'm going to assume it's been trading at about that level for the last 5 years. I'm going to assume it trades back to that level. I think once interest rates begin to fall, it will give this company a big boost, and we'll see why as we begin to look at the KPIs. Now, a couple of key points here. This is based on the analyst's estimates for the operating earnings. We can see here, for example, 6 months ago, 3 months ago, previous, and the current EPS estimates here. And we can see that as we look through these numbers, we can see they've been reasonably stable with small drops in general. Now, if these analyst estimates are correct and the earnings in 2026 come in at $5.11, and the prices also see a multiple expansion, so they return to 13.6 times in a price to earnings ratio, this would suggest that we'll have a total annualized rate of return of 20.8% per annum, which is a combination of 60% growth as well as adding in those dividends. So healthy, I think, growth ahead potentially. Now, FastGraphs also has the ability to quickly look at some of the key elements here. So number one to look at is probably the margins. We can see that the margins are higher than the industry average here. Operating margin, gross margins are higher. Operating margins are slightly higher than the industry average. Net margin's been a bit variable. Had a bad year 2022, but seems to be back into the positive territory that we've seen for the last 10 years. So the margins are looking good. Return on equity generally has been looking much more positive, and since about 2010, 2011, and we can see total equity has been generally creeping up along with net income. Asset turnover, again, these numbers are looking better than the sub-industry average in the last 10 years or so, and the long-term debt to capital ratio as well fluctuates a fair bit, but around average. Now, as we go through here in the fiscal fitness as well, we can very quickly, this is one of the reasons why I like FastGraphs, I can very quickly see visually some of these key figures here. For example, return on invested capital is a metric I do view, and even though it was fairly low here in 21-22, it picked up in 2023, which also encouraged me to add to the position. Share buybacks is also a useful one to look at, and again we can see here 6.7 billion shares outstanding in 2003 down to 4.15 billion shares in 2023, so we're talking about some fairly substantial share buybacks of about 2% per year on average. Sales revenue should be going up. That's what I love to see. Operating cash flow over net income, and again I can see operating cash flow is much higher than net income, so this is all looking very good. Free cash flow to dividend is very important for me as well. Do we actually have the cash coming in and available to pay the dividend? And in each case we can see that the green free cash flow to equity per share is dwarfing the dividends per share, so there definitely looks like there's going to be room for them to continue to increase their dividends in the next several years as well. Now, what FastGraphs doesn't allow me to do after looking at all of these financial metrics is it doesn't allow me to really quickly see what's going on in the actual company itself. Now, as a platform, it does have this option here for external links, so I can, for example, jump into Morningstar quote. We can also look at the corporate website. We can also pull up, say, Seeking Alpha Research and things like that. So Comcast here is rated at a 4-star, and the rational broadband competition lends Comcast stability as its media strategy evolves, they say. So it's looking like this could be a good opportunity here based on what the Morningstar analysts are seeing. But can we do better? Can we actually see what's happening inside of the company? And the answer is we can go through, we can read all the reports, or we can use the Business Quant platform, and it allows us to take a number of items here where the analysts at Business Quant have actually gone through and they've pulled out all of this data from the reports from the company, and they've compiled it into data sets and then enable us to plot and chart it. Now, for example, wireless customers, we've seen that the wireless customers increasing quite strongly here over time. Voice customers, we can see, is much more mixed, where the business service customers at a very small proportion seem to be fairly stable, a bit of a drop there, but we can see that residential voice customers are beginning to drop off a cliff, particularly here after 2020. And so Business Quant as a platform allows us to go into the company KPIs and really understand what is important to them, and actually also get a good clear picture of some of these underlying trends, such as broadband customers, such as the data from their cable networks, which seems to be relatively stable as well, which is good to see. I'd expect costs to be escalating a fair bit, but perhaps not as much as I expected, so they seem to have done a good job in terms of managing the costs, although we can see costs for most of this increasing, I think here, particularly into 2022. High-speed internet customers, we can see some healthy increases here year on, year out. The Peacock subscriber levels, we can see some very strong growth here over the quarters here, so growing from about 3 million in 2021 through to 31 million in 2023 quarter 4, so some strong Peacock subscriber growth there. So when I'm seeing all of this, I'm seeing some very good value where the company does seem to be doing very well. Now this is also important here, so the single product penetration seems to be very high, double product penetration seems to be down, and triple product penetration and quadruple product penetration seems to be dropping as well. That's not so positive. Revenue by business vertical, connectivity and platforms versus content and experiences. So we can see some fairly good stability there. Revenue by segment, now you'll see the big jumps here as they change what they are measuring, and you can see here broadcast television deprecated as they begin to switch what they're measuring and how they're measuring it. So media seems to have been dropping off a cliff here, and we're missing some of the more recent data here, which seems to be reported on the annual basis as opposed to the quarterly reporting here for some of this. Subscribers by offering. So if we unselect all of these, wireless is going up strongly, residential voice down, voice business very marginal anyway, video residential customers down, video business customers on average, small growth in security, HSI residential increasing, and HSI business services seeming to increase as well. So we can get a sense of these subscriber numbers as well, and they seem to be trending in the right direction. And so this is one of the beautiful things about the Business Quant platform, is it enables us to do this, it enables us to capture these key pieces of data.